I think I was asked in January, February this year what my prediction was for the end of 2025, and I said $40, or at least I think I said $40, and we blew through that like butter. I think we're going to see new highs. I think we're so close to $55 last week that the market just had to kind of do one more sell-off to drive it down a little bit. It's destined to go through new highs here, and whether it hits 60, 65 by the end of the year, I wouldn't be all surprised.
I was looking at 36 to 36.50 as being where a serious correction might stop. There's a little bit of support on the chart, not a lot, but a little bit, and it would be a reasonable enough decline from 44,000. There's a lot of pent-up demand for gold. I think we'll get that demand come in before we get down there.
Keithneumeyer and Adrianday highlight how rapidly market expectations around silver and gold have shifted. What began as a conservative call for $40 silver by late 2025 has already been eclipsed, with prices slicing through that level effortlessly and pressing toward fresh highs. The brief stall at $55 looks more like a routine pause than a reversal, and both analysts point to the $60 to $65 range as a realistic year-end target. On gold, Adrianday notes that the pullback toward the mid-$3,600s is a natural retracement within a powerful trend, a level that may never be fully reached due to strong underlying demand. Structural tightness, investor appetite, and momentum all suggest that buyers will reappear well before deeper support is tested. The broader setup remains firmly bullish, with higher highs increasingly likely. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
I think we're close to 40. I think just slightly shy of 40. I think we beat the COMEX by maybe 50 cents or something. It did spike a lot. End of September, in October, we saw basically $55 silver, and I think that our Q4 average will be probably much higher. Well, I think it started with the tariffs, going back when, during Trump, when Trump was talking about tariffs in the US. And so a lot of the metal moved from Europe to New York or the United States, COMEX or whatever. And that included silver as well. And then all that had to be unwound quite quickly, because all of a sudden the London market starts to get issues with deliveries. And interestingly enough, if you look at the Shanghai numbers, and because I see the Shanghai reports every week, and Shanghai warehouses are now down to 2015 levels, which is crazy. So, this silver is being consumed in industry and is being moved around, and it is a bit of a bulky metal, and but it does get consumed, and that's different, as I said earlier, than gold. And because you don't recycle cell phones, you don't recycle computers. A lot of this silver that we consume just gets thrown in waste dumps. And it's getting a real problem. And we've now had 5 years of deficits in the silver market. The deficit on a combined basis over that period of time is close to 1 billion ounces. The miners are only producing about 850 million ounces a year, and we're consuming like 1.2 billion. So these ounces are coming from somewhere. They're coming from investment hordes or governments, but that's going to end. And we have to see higher prices too. And I've said it a dozen times to get the miners, the mining companies, to start producing more metal to fill that gap. But we're not going to do it at $50 silver. Yeah, well, the central banks have been really the driver behind the gold price, and they've been in the market now for a couple of years, and they're just buying a whole bunch of gold, as you know. And so silver took a little bit of time because people were waking up to gold and seeing it hitting new highs all the time. And what's the brother to gold? Even though I don't look at silver as I do look at gold, I think they're totally different. I look at gold as a currency. I look at silver as an industrial metal that's required for all the things that we need to do, electrifying the plant and so on and so forth. So I treat them differently, but the market woke up to it. So it was quite exciting to see. I remember the move, that took place between 2009 and 2011. And, when silver broke out, through $30, back in early, I guess it was, early 2011. That whole move from $30 to $50 is basically short covering. The banks got completely caught offside. That was all paper driven. And that's why it ended so quickly, because it was driven by short covering. And this rally that we've seen over the last few months is all physical demand. It's completely different. People are waking up. The United States government is deemed silver as a critical mineral, as you probably know. And I think that woke up a lot of people. And people are now saying, hey, look, this metal is really, really important for things like this. And we're not going to travel. We're not going to be able to drive. We're not going to be able to operate our homes or, whatever the case may be. Silver is a very critical metal. And people are waking up to that fact. So it's pretty exciting to see. It happened a little more quickly than I would probably like, because it did get a little bit parabolic, and it needed to see a correction, and we're seeing that now. But it's going to settle, and who knows what we'll end up with at the end of the year, but likely higher than its current trade. I think I was asked in January, February this year what my prediction was for the end of 2025, and I said $40, or at least I think I said $40, and we blew through that like butter. I think we're going to see new highs. I think we're so close to $55 last week that the market just had to kind of do one more sell-off, just drive it down a little bit, and it's destined to go through new highs here, and whether it hits 60, 65 by the end of the year, I wouldn't be all surprised. Saw a stat, and you probably see the same stuff I see, and I think there was like 75 million ounces of silver or something shipped to India over the last couple of months, which is quite amazing when you're only producing 850 million ounces a year. So but it's all in industrial. Like you just look at AI, for example. You're building all these data centers. How are you going to do that without silver? The nuclear renaissance. And now governments are talking about turning back nuclear, back onto the grid and building new nuclear plants. There's something like 30 nuclear plants planned for. There's a major announcement that came out of Westinghouse, just recently.
Silver's surge toward the mid-50s reflects a market finally responding to years of structural tightness. Inventories in Shanghai have fallen to levels last seen in 2015, while 5 consecutive years of deficits have removed nearly 1 billion ounces from global availability. With mine supply stuck near 850 million ounces against demand above 1.2 billion, the drawdown has been filled by investor and government stockpiles, an unsustainable source that is quickly thinning out. Rising industrial use from AI data centers, electrification, and an accelerating nuclear build-out continues to tighten the market further. The recent breakout above $50 signaled the shift, and even with brief pullbacks, the path toward higher highs remains supported by fundamentals. Large shipments to India underscore the scale of global appetite, adding more pressure to the limited supply. Let's get into the interview.
Yeah, well, gold, clearly in September, October, gold clearly just ran up too far. See that chart, and every day another $100. That can't last.
Yeah.
But if you step back, one of the things I said in my speech yesterday, if you look at a 50-year gold price on a log base, not an arithmetic chart, but a log basis, look at it in percentage terms. The rally we've had in the last 2 to 3 years is far less than the rally we had in 2009 to 2011, and less than the rally we had in 1979 and 1980. So in terms of previous market peak, we haven't had that kind of rally.
Yeah.
And I think I don't think this is the top. So
Yeah.
that's the first thing. I don't think this is the top. Some people are nervous. Oh, we've ridden this up and ridden for 2015, 2018, 2020. They don't want to do it again. We are so far from a top right now. As I just mentioned, the actual move in percentage terms, less previous tops.
Yeah.
I was looking at 36, 36.50 as being where a serious correction might stop.
Okay.
There's a little bit of support on the chart, not a lot, but a little bit, and it will be a reasonable in 44,000. There's a lot of pent-up demand for gold. I think we'll get that demand come in before we get down there. These things are pullback. We need a pullback in gold. If you look at the last 3 years, we really haven't had a proper pullback, let alone a correction. This isn't a correction by definition, but we haven't even had a decent pullback till now. So I think, these things always last a little longer for hope or effect.
Yeah.
But I just don't see it being a very deep, for the reasons I just said. The stocks are still remarkably undervalued. Drivers for gold still remain. Central banks are still buying gold. You just saw the latest report from World Gold Count, August, admittedly. That's the comprehensive one. But if you look at the individual central banks reported for September, still buying in September. So I just don't see a very deep, much deeper from where we are. What's going to turn it? What could make it go deeper? I guess if everything started to go wrong, gold. So, the Federal Reserve keeps coming out saying, take December off the table.
They balance the budget.
But I would say, peace deal in Ukraine or Gaza stick, just things start to, quote, go wrong for gold. Now, those last, I should just say, because it sounds a bit hard to be looking at those, human tragedy. The truth is that the war in Ukraine and Gaza situation did not really add much to the price of gold. Are they gold positive or gold negative? Clearly they're gold positive. We can't do that. But that's not why people are buying gold. They're not buying gold. Ukraine is a perfect example where the price of gold moved up for the 3 weeks ahead of the invasion, as there was all the speculation about invasion.
Yeah.
And it peaked on the day the tanks rolled across the border.
Yeah.
And within another 3 weeks, it was back to where it was.
Yeah.
So geopolitical events generally do not really add much gold on a long. But when you're in a weak situation like this, anything that is gold negative can make sell.
Okay.
I don't know. Did I explain that properly?
Yeah.
I hope I did. And so you could have that kind of thing, and of course, a bounce back send gold
with grenade gold. We all know that's not going to happen.
But what's going to make gold turn around and move up again? Again, it could be we may have to wait to the Fed meeting in December if it appears then that they're going to cut rates, and they do cut rates, because at the moment it's basically 50-50 in the betting markets, right, to whether they're going to cut rates. And I think, frankly, the Fed is probably at the moment. But if as we get closer to that, then the indications are that they probably will, and they do, that could certainly help gold. If September's and particularly October's central bank buying comes out, banks actually start picking up their buying on the gold dip, that would certainly help. I think one of the, apart from the fact that, gold too far too fast, so we sort of started to run out of buy. People who, even those who are interested in buying, say, well, let's step back a bit.
Gold's recent surge may have looked overheated in September and October, but the broader structure still signals a market far from any lasting top. On a long-term log chart, the current advance remains modest compared with previous secular peaks, suggesting this cycle has much more room to expand. Even with short-term exhaustion and a necessary pullback, structural drivers remain firmly intact: central bank accumulation, undervalued mining equities, and steady long-term demand from institutions. Corrections at this stage are healthy resets, not reversals, and the current retracement lacks the depth or duration typically associated with a genuine trend change. Unless multiple macro forces simultaneously break against gold, the underlying bid should remain intact, with dips quickly attracting fresh capital. As long as the fundamental engines continue to fire, the long-term trajectory stays firmly pointed higher. If this gave you value, smash that like button, share it with those paying attention, and subscribe so you don't miss what's coming next. Stay alert, stay prepared, and keep stacking tangible assets.